Wow, 40 people already.
John, take it from here.
All you, E.
Okay. Hello, everybody. Eric Morganson with Angel Oak. Appreciate you guys taking time out of your busy day to learn literally about how to make more money when it comes to this underserved market out there of non-agency, some call it non-QM borrowers. We're going to get this started in a few moments. Let some other people just be logging on right now. And hopefully this technology works where we can ask some polling questions for you out there. So we want this to be interactive for you. And here we go. Everybody can see my screen. Stephanie, Scott?
Yep.
First off, I'd like to introduce Scott Grubel and Stephanie. They are two of the most successful account executives in the history of non-agency, non-QM lending. They are geniuses on structuring loans for very complex loans when it comes to borrowers that might have, 1 to 7 different companies. Literally what we're doing is moving real estate, again, towards that underserved market. So I'm going to get started on this PowerPoint. What we're going to do today is we're going to show you literally we're going to scratch the surface on 3 main programs today. What does a portfolio type of home shopper look like? Why is this market changing so dramatically right now? How can you guys make more money by doing these type of putting your clients into these type of loans? Where can you find these home shoppers? And literally, we're going to need your help getting the word out that these programs even exist. And then we have some of the best practices when it comes to this space, also known as the non-agency or a non-QM. All right, so as far as all of the refis going on right now, I know a lot of you realtors out there are feeling some turn times when it comes to your purchase loans because of the huge refinance boom out there. Appraisals are taking a little bit longer than normal and so forth. So all of those type of home shoppers that you're normally used to putting into homes, FHA, VA, and agency, as we call it, those are right down the fairway. However, there is this underserved clientele out there that can take up, that is as much as 20% of the market that really nobody's paying much attention to. So why does it matter about knowing about these? Well, think about it. If you can close 1, 2, maybe 10 extra transactions a year, what does that mean to your checking account? What does that mean to your referral network? So who are these type of non-QM folks out there? Well, as you can see, these are people mainly, about 70% of our volume here is mainly the self-employed borrower. So folks, there are millions and millions of self-employed people in America. We are the country of entrepreneurs. And with that said, never before in the history of America can somebody self-employed write off everything on their taxes and show only $30,000, let's say, in income for the year, but yet go out there and buy a $500,000 house. Never before could you have it both ways. You had to used to amend your taxes to show enough income to qualify for a house. Well, now these self-employed borrowers can have it both ways. They can have all their write-offs, and yet you guys can still sell them a home. Scott, Stacey, you guys want to add anything to this?
Stacey?
Yes, kind of what Eric's touching on too is this self-employed, and we'll get into more details as we go through. But these self-employed borrowers that write too much off, which we all know we all would if we're all self-employed, and you realtors being 1099, when you go to do your taxes, we don't want to give Uncle Sam, more money than he deserves. So we're going to use our write-offs. So these borrowers, we can help them through our bank statement programs and 1099 programs, where we're basing it solely on their deposits that are going into their bank statements and not what they're claiming on their taxes. So again, we'll get into this program along with our no income cash flow program later in the slides, but that's kind of what we're touching base on is how we can help these people that aren't showing their income and writing too much off.
Excellent. Thank you, Stacey. Scott, let me ask you, what kind of vocation, what kind of job field do you see most of your bank statement loans? What does that borrower look like?
The bank statement borrower, what's beautiful about these loans, and I think this is obviously one of our most popular programs on the non-QM side by volume. I think this is probably the one that can impact the realtor community the most, in the sense that your knowledge of this program and how it works will 100% help you put buyers into more homes and close more transactions this year. But it's ironic because if you really think about it, the buyers that are buying usually the jumbo properties, the high loan amount properties, the little bit more luxurious properties, they're usually your self-employed borrowers. It's not going to be always a W-2 person making $250,000, $300K a year on a W-2. We don't see that often. It's usually going to be a business owner. It's usually going to be somebody that maybe is in a commission-based business, a realtor, a loan officer, for example. We do numerous realtors on a monthly basis on not only the bank statement program, but on the 1099 only program. So this is a good one where I think we're going to dive into it a little deeper a little bit later, but definitely want to make sure as a realtor that you have good knowledge of this program, because it's going to help your bottom line.
Thank you for that, Scott. So listen to that. The number one vocation, the number one occupation on bank statement loans here at Angel Oak, and we've done more than any lender in this field, are real estate agents. Think about it, folks. You're writing everything off. Anytime you're traveling, you could potentially be driving to show a property. All your entertainment, you're potentially taking out clients. You write everything off. That your broker check comes into your personal checking account, and obviously it is a program kind of designed for you folks as well. All right, moving along, credit events. Credit events is a nice way to say a bankruptcy or a foreclosure. Now, all the money center banks like B of A, Wells Fargo, all these good people at Chase, they make a borrower wait 4 years on an agency and 7 years on a jumbo loan. At Angel Oak, we can do a loan for somebody literally 2 years outside of a Chapter 7. You can now sell them a house, or even 1 day outside of a Chapter 13 if they filed for Chapter 13 24 months or longer. Think about it. Somebody that restructured their debt, still paying it off, made a payment plan over the last 2 years and stuck to it, and now yesterday was discharged from that bankruptcy. You folks can now sell them a house. Nobody's talking to these people. Stacey, anything you want to add to credit event borrowers?
Yeah, a lot of times too, what we'll see, Bank of America is infamous for not taking our borrower out of title for years. They've had to go through the plethora of people that foreclosed, and it was taking them years to get the borrowers off of title. So when you're looking at a loan to go conventional, it looks like they may have just had a foreclosure 6 months ago. Really, it happened 4 years ago, but it's taken that long to get the borrower off title. We can do that. We're not going to discredit or hold it against the borrower because the bank took forever to take it out of our borrower's name. I see that all the time. If it was discharged through a bankruptcy 4 years ago, but just took their name out of title 6 months ago, I'm still going to go off that discharge date of the bankruptcy of 4 years ago and not hold it against our borrower that Bank of America dragged their feet for 4 years. So that's also good to keep that in the back of your head as well.
Very nice. And Scott, forbearance. What if somebody stopped making their rent payments or stopped making their mortgage payment, but their company's been doing very well and they chose forbearance? Let's talk. Can you let us know a little of that?
Absolutely. We have options for those borrowers. Anybody who took a forbearance during the last year, COVID, we have options for those borrowers to get them to qualify. Once the forbearance is completed, they're back to making their payments. We have a few different programs in which we can squeeze them into. We have a lot of realtors on this program, on this call right now, and I'm sure you guys have all been in that situation where you had a buyer sent it to your mortgage partner, your loan partner, and they pull credit, everything looks beautiful, they're submitting it conventionally, and then you hear about a fraud guard that is pulled by the lender, and a bankruptcy or foreclosure or something pops up that was nowhere to be found anywhere else. 9 out of 10 times that loan is going to die conventionally. However, through these programs we're talking about right now, we're able and we do save those loans on a daily basis. That's another big one to know.
Indeed. Okay, moving along right here. As far as real estate investors, Freddie Mac stops at 5 finance properties. Fannie Mae stops at 10 finance properties. You real estate agents out there that have clients whose business model is buying investment properties, after 10 that they financed, what do they do now? Stacey, if I've financed 10 investment properties, but I want to buy more investment properties, what do I have to do now?
You're going to call your broker and they're going to call us at Angel Oak. We'll finance properties. We don't care how many a borrower owns. They can have 50 finance properties. They can have 100 finance properties. It doesn't matter. It's unlimited on this program. What's great about this program on the slide that you have up too is a lot of investors want to close in an LLC. Closing in an LLC is fine. And the big thing with us is the LLC doesn't have to be seasoned any length of time. They can open the LLC today and close on it tomorrow. That's huge for investors. I know they all like to have their investments protected by that LLC corporation. So that's a great, the investor cash flow is one of my favorite programs along with the bank statement program, because it does allow borrowers to get these investment properties without a debt ratio, without qualifying with their income. It's based solely off the cash flow of the property. So as long as your market rent on your appraisal covers your PITI, your principal, interest, taxes, and insurance payment, you're good to go. And the other big thing with us, we go up to 80%. That's only 20% down, and you don't have to verify anything. Rates are phenomenal. A little as 20% down. These investors don't have to show their bank statements, don't have to show their tax returns. They love this program. And we get a lot of realtors that like this program for themselves as too. The other big thing with us is they don't have to have investment history. They can just start getting into buying investment properties. We know rates are down right now. People are wanting to invest in real estate. So they can start adding to their investment portfolio with us. It's a phenomenal program.
It is. And we go head to head with hard money lenders here, or I should call it private money, because hard money, private money rates are in the 9s. Their LTVs normally about what, 65, sometimes 70%. And it's normally anywhere from a 1-2 to a 5-year balloon. And they're very expensive on origination fees. With Angel Oak, all of our programs are 30-year fixed. We go up to 80% loan to value, and our rates are in the 4s, 5s, and 6s. So if you realtors have clients that you've sold investment property to that for some reason had to finance it with hard money, you might consider reaching out to them for a refinance. We can even do a cash out on these up to 75% loan to value and use that money as a down payment to go buy more investment real estate. Because Scott, today, rental income is at its all-time
high.
That's it. So there's a big opportunity for you folks out there with that. We call it the investor cash flow. Okay, so now what if you guys talk to me about somebody that is no longer working? Let's say they're retired. They got a boatload of money in their 401k or in the stock market, and yet they're looking to buy a house. Maybe even the big house that they have now, they want to downsize, but they're afraid to move because they're not going to be able to qualify for any loan. What do I do with this situation, Scott?
So it's Eric, I have 3 loans in process right now for buyers who, unfortunately, all 3, same exact scenario, went under contract before really getting fully pre-qualified. And once we ran the numbers, They did not have enough income to qualify conventionally. They were not self-employed. We couldn't go with a bank statement program. However, they did have a significant amount of assets in the bank, numerous assets, 401ks, IRA, security, liquid cash. We're able to use all of those assets, and we're able to qualify the borrower using a calculation of those assets. So there's 3 loans there we were able to save using that program.
Nice. And let me just touch into on every owner occupied loan that anybody does in America currently, they have to be what is known as ATR compliant, meaning we have to document the borrower has the ability to repay the loan if it's an owner occupied property. Now, Congress doesn't care if somebody loses their investment property, boo-hoo, right? But their primary residence where their family sleeps at night, this is where these loans all have to be ATR compliant. So to all of these loans that Angel Oak does, why you might think these guidelines are a tad aggressive, they are all ATR compliant, meaning we do document the borrower does have the ability to repay these loans. So with that, thank you, Scott. Okay, so people out there that you real estate agents, I'm sure all of you have a client, had a pre-qual letter. All right, let's start the home shopping. And you're driving all over Kingdom Come and you've showed them 5, 6, 12 different houses. Now, hey, on this one, we're gonna make an offer. You write up an offer, it's accepted, that pre-qual letter, now let's go get the loan. Wasn't worth the paper it was written on. This is where we want you to remember Angel Oak and these programs when you have a loan, that when you have a potential sale that for some reason the loan blows up. This is our lane. All right. So, all right, again, the wrong income. Stace, do you want to let them know just really quickly, briefly, how we qualify the income on a bank statement loan?
Yeah. So when you get a borrower and you're, again, driving around, you find out that they're self-employed, they write everything off. So you're going to reach out to your mortgage broker. If you don't have, or you're not working with a mortgage broker, feel free to contact us and we will get you set up with a mortgage broker that's approved to do these loans with us. We're the wholesale side, so you won't be working directly with us. So if you have a relationship with a mortgage broker, you're going to continue using that mortgage broker, who in turn is going to be giving us the loan. The great thing about our bank statement loan, again, like Eric said, you might be driving around with somebody showing them these $700,000, $800,000 homes, or even less, thinking that they're not going to qualify for more. We calculate the income up front on the bank statement program. So your borrower is going to get together 12 or 24 months of bank statements, send them to your mortgage broker. They're in turn going to send them to Angel Oak's rep, Scott, myself, Eric, whoever their rep is in the area. They're going to send us the bank statements. We're going to get the income calculated for you up front. So we're going to add up all their qualifying deposits, divide by 12 or 24 months, apply an expense ratio if needed, and then we're going to say, okay, here's the income that you have to work with. So now we may have narrowed down your search. So now you can be a little bit more prepared when you take this borrower out to start showing them houses. And instead of showing them $200,000 houses, maybe because they actually show a ton of deposits on their bank statements, you may have just increased your potential to $500,000 homes. So the great thing again is we'll calculate on a TBD property upfront, give you and your mortgage broker the income that we calculate and say, okay, here's now your price range that you can start shopping for. That to me is a huge benefit to you as a realtor to not waste your time.
Think about what Stacey just explained there. Angel Oak, through your broker, is going to give you a full credit and income underwrite, normally within 24 to 48 hours on a TBD property. Nobody out there in America is going to underwrite a file for you on a TBD property, folks. You have to have a purchase contract for that to happen. These pre-qual letters that you're going to get from certain players out there in the marketplace, as you all know, sometimes they're not worth the paper that they're written on. Now, another point of what Stacey was saying, this is through your favorite broker. the real estate community out there. You can't, and if your favorite loan officer works at Wells Fargo or Chase or B of A, unfortunately, there's a federal mandate that they cannot offer bank statement loans. So this is through your favorite broker out there. Thank you, Stacey. All right. So self-employed. How many self-employed borrowers are in America, you guys? Depending on the statistics, it's anywhere from 17 up to 45 million self-employed Americans. Now think about that. That is literally 4 times the size of the VA market out there. So again, we need your help getting the word out that these programs even exist. Scott, anything you want to add to a typical scenario like this?
Yeah, I'd love to. So in discussing, Stacey nailed it on the head, and discussing that and spinning off that, the majority of the time, you guys as realtors know, if you have a self-employed buyer, the tax returns are reviewed by your loan officer, your mortgage partner, and they come to you and say, here's the buying power we have. We all know these self-employed borrowers are doing what they have the ability to do, and that's write off everything, so the net income is going to be minimal. A lot of times they'll provide a solution, say, hey, so what we'll do is let's just go amend last year's taxes, or we'll change the current year's taxes we're filing to increase the income.
Ouch.
Going with the bank statement program, ouch is right. There's a whole lot of things that can go wrong there, reporting X amount of income for so many years, and then all of a sudden you have a year where, boom, you have a huge amount of income reported. But I'll take it a step further. Even if they did that, I'd say 99% of the times, the buying power we're able to produce for your buyer is double, triple, in some cases up to 10 times more by calculating the bank statements, because we are using gross deposits. We're taking the total deposits in those bank statements, and we're running our income calculation based on those deposits. It's a totally different ballgame. So if your loan officer, even if they do amend those taxes, and your income goes from 50,000 to 100,000, through your bank statements, you might have 200,000 in income. And for you as a realtor, how much value did we just add to you, where your buyer now has double the buying power to afford a bigger house?
Well put. Now, your real estate agents out there, you guys are paid on the value of the listing or the purchase price of that house. What Scott just explained is on a regular full underwrite conventional, let's say they qualify for a $250,000 house. Using an Angel Oak bank statement loan, now they qualify to buy $1 million house. And our bank statement rates, folks, are starting at 3.375%, and that's a 30-year fixed loan, no prepay. So we're here to literally double your commissions out there and put people into nicer homes and that would have normally qualified. Thank you,
Another
Scott.
great thing about the bank statement program too, guys, is borrowers aren't usually, even though our rates start very, very low and they're extremely attractive, even if they're in the 5% and 6% range, again, depending on LTV and mid FICO scores, but bank statement borrowers don't argue about rates because they know they can either claim all their income and give Uncle Sam 30% of what they really make, or they can take a 5% bank statement program for a 30-year mortgage. I mean, it's a no-brainer for them, and they're just so happy to get into a house that they can actually qualify for and not settle for a smaller home.
A lot of wisdom to what you just said there, Stacey. For you real estate folks out there, I believe that you're in the 3rd most emotional business in the history of the planet. I think the most emotional business would probably be a divorce attorney. The 2nd most emotional business probably be an undertaker or somebody, managing a mortuary. The 3rd most emotional business is that of real estate. You guys know how emotional it becomes when they see this house, and boy, they gotta have it. These loans will put your clients into those homes. And you're right, Stacey. It's really not about rate. It's about, I have to get this house. They're emotionally attached to it. So excellent. All right, next. Let's talk about folks that everybody is saying, nope, sorry, you don't qualify for a loan. Oh, and now they've applied maybe through LendingTree and it comes back to them, and none of these lenders, even on LendingTree, can do a loan for them. And guess what they believe? They believe they don't qualify for a loan. They just simply don't know about these programs. Scott?
Yeah, so on non-QM, our bottom line is our seasoning requirements for any housing events, short sales, foreclosures, deed in lieu, forbearance, they're lower. They're lower than conventional. It's that straightforward. So where in your mind you might be thinking, oh, I may not be able to get this borrower a loan because they had a housing event or a bankruptcy event and it hasn't been the required 7 years or whatever the case may be, non-QM loans can get those loans done for those buyers. Don't turn them away. Most of our programs were at 24 months on the seasoning. So we can get these loans done if they've had that short sale 3 years ago, foreclosure 3 years ago. Chapter 13 bankruptcies, we can go off of the filing date as opposed to the discharge date. That is huge. Filing dates are usually 3 years prior to when the BK was discharged. So these are really important things to know. Again, knowledge is power, knowledge is profit for you guys as realtors. It's really important for you guys to know that these programs are available to your buyers.
Thank you for that. And by the way, I just want to remind everybody, we are recording this. So if you want to share it with your fellow real estate agents in your offices, please do so. Also, we have local representation with Angel Oak account executives. So if you want to have a local Angel Oak rep come into your real estate office to better explain these to your coworkers, we're all in on that. All right, moving along. So, here is, well, how do I put this? We have so many loan scenarios that Angel Oak has been in this space 7 years. So after 7 years and multi-billion dollars worth of funded non-agency loans, you guys, you think we've seen it all. Right when you think you've seen it all, now in comes a scenario that you've never imagined. And there's no way to possibly equate and put into guidelines all that is of the human element out there. So what we're really good at is give us a scenario and we will unpack that for you. We love scenarios. And when you have a potential home buyer that has a very quirky kind of a scenario, this is our lane. As far as an asset qualifier program, Stacey, Scott, you guys want to touch in about, you have a loan story about this one?
I do. I did a asset qualifier program for a professional athlete. They didn't have 3 years left on their contract, and with conventional or even non-QM, you have to have, if you are a W-2 employee, you have to have 3 years left on your contract. This particular athlete only had about 1.5 years left, so I wasn't able to do it on the regular full doc program. So what we did was he had a ton of assets in the bank. The assets have been in his bank and seasoned in there for 6 months. And we just based the whole loan on just their assets in the bank and got it. He was ecstatic about it. Rates were super low and it just worked out perfect for him. It was nice to have an outlet for somebody that didn't have, athletes make a ton of money, but because that contract wasn't going to continue for three more years until he signed a new contract, it was great having an outlet for him.
And Stacey, he always had that option of depleting all of his investments and turning around and stroking a check for that property. But wouldn't that be a point of pain for him? Because you guys, the investing money in the stock market these days, you can make a lot of money, so you don't, that's a pain point. We don't make them literally liquidate their investments in order to buy their dream home.
No need to liquidate, no need to pay those capital gains taxes. Hold on to your assets, leave them invested right where they are. We're just going to take the total value of what they are today, and we're going to qualify you based on that asset.
Excellent. Okay, so you guys, for all you real estate agents out there, having well, even yourselves, whenever I do a realtor presentation, by the time I'm done, 1 or 2 real estate agents approach me trying to do an ICF loan for themselves. because
Yep.
you guys are coming upon all sorts of different properties out there. And again, rental income, it's at its all-time high.
Hi.
We do a ton of these loans and they're so easy. I could even underwrite one, couldn't I, Stacey and Scott, huh? There's no income on the loan application. You leave the employment section blank. Scott, you want to elaborate on that?
I would. So Stacey explained it, and I just want to drill it home one more time. As realtors, I think you guys will really appreciate this program. To me, it's the second most important one you need to know and have in your tool belt. Because, and I know a lot of realtors do a lot of investing as well, but just look at it from the top. 20% down. You on an investment property, you can go up to 80% loan to value with no income verification, no employment verification. The loan is qualified based on the gross rental income the property generates, the gross. So if your proposed payment on this property is $2,000, as long as that property is generating $2,000 in income or more, in rental income or more, your loan qualifies with no employment verification, no income verification. We don't look at taxes. There's no ratios. We don't care what liabilities you have. We don't care how many properties you own. This is huge. And like Eric said, with rents being at an all-time high, qualification for these programs right now is very consistent. We even take it a step further. If for some reason the rental income is not covering the proposed payment on the property, we'll still do the loan for you with no income, no employment verification with 30% down. So you put a little bit more money down, we're not worried about the rent covering the property. I can't explain how huge this is for your investors, for your realtors that are looking to buy properties. As Eric mentioned as well, I see a lot of this activity going on. Loans that I've closed, people that have purchased properties using this program are now pulling cash out of those properties with values where they are and using that cash to take advantage of more opportunities and buy more investment properties. They're increasing their cash flow. Talk about cash flow. We'll take it another step, and this is incredible. We actually offer an interest-only option on this program. So as we all know, with investment properties, cash flow is king. That's what it's all about. If you go with an interest-only product on this program, without verifying your income, without verifying your employment, you're buying an investment property and your payment is now only interest, your cash flow just went up in some cases 20, 30%. It's a home run.
Indeed it is. Indeed it is. Okay, so all we want to do is see the stuff that you guys are having a problem finding a loan for your clients out there. Again, we just want you to literally think about Angel Oak and what we do best. We take complex scenarios that can't fit into agency, can't fit into the jumbo prime, and we turn those into funded loans and you guys can close your transaction. So, all right. Let's talk about the size of these markets out there. My favorite, you guys, again, and I keep coming back to it, is the self-employed borrower. Self-employment in California, nearly a third of self-employed people in America live in a single state, and that's California. And the U.S. entrepreneur is unlike any other type of person out there. They're risk takers. These men and women out there that start these companies, never in the history of America has a pessimistic person started a company. So entrepreneurs are very optimistic and they're risk takers. Well, a lot of times, boom, they've had a business and it's failed, and that's okay because they keep getting back up. We're okay with doing a bank statement loan with somebody that's had a bankruptcy inside of 7 years. If a bankruptcy or foreclosure happened more than 4 years ago to us, it's as if it never even happened. So with that said, look at this, 59 million people are categorized in the gig economy. So what Angel Oak will do is we consider somebody self-employed if at about 35% of their income comes from self-employment. Well, we can do a bank statement loan for them and use their W-2 income. Stacey, you want to elaborate on a bank statement loan where maybe the husband works at a W-2 company, literally taking advantage of the health plan of an employer, but yet his wife owns a company. Can we use both of their income?
Yeah, we sure can. We can use both of their incomes. The W-2 borrower, we're going to ask for their 2 recent last year's W-2s and pay stubs. We don't want to see their tax returns at all because we're using the bank statement program for the self-employed borrower. So the self-employed borrower is going to, their income is going to be calculated off the deposits that are going into the bank account, while the W-2 borrower is going to be going off of their W-2s and pay stubs. We can use both of their incomes. You also might have a borrower that's self-employed, but also might collect pension or Social Security or child support or alimony on the side. Again, we can use that second source of income on top of a bank statement program. So a lot of times that might make the difference of, again, purchasing a home maybe larger, or maybe just getting, making sure that they qualify for the home that they want.
That's it. Excellent. Okay. So how do you find these people out there that don't know that these programs even exist? Where, Scott, where would you go if you were a real estate agent? Where would you go to find this underserved clientele?
Well, I think one of the biggest sources would be your accountants, your CPAs, right? Because they're the ones doing the taxes for these self-employed borrowers. They understand the situation. Every CPA I've ever met and spoken to, when I've explained how the bank statement program works, light bulbs are going off. They think it's genius because they understand the complexities of the tax return for a self-employed borrower and the repercussions of changing those. To be able to qualify the borrower on the gross revenue of the business based on the deposits is genius. So they love it. Builders and developers, of course, they're especially, high-end communities. I think those are great sources. And then obviously just marketing them out there within your network. We all know people that own businesses, whether it be a small local business or maybe they're a 1099 independent contractor. What I have found personally with a lot of the brokers I work with, and therefore the realtors they work with, is it kind of spreads organically. Once you're able to get one of these loans done for a self-employed borrower, they usually know more other self-employed borrowers. Same thing goes for the investor community. And so it grows organically from there. But the important is getting the message out of these programs and that they're available to them.
Indeed, birds of the feather flock together. So with that said, folks out there, anytime you have to have a license for something, that is public data. So we all know that anybody in the construction contracting business right now is printing money. We all know that CPAs literally have, if you're self-employed, normally you're not doing your own taxes. If you're a W-2, it's pretty easy to do your own taxes. Even TurboTax is free these days. It's crazy. But these CPAs out there, they have all these self-employed type of clients out there. And they normally, if they're a good CPA, they sit you down and go, okay, Stacey, we're doing your taxes this year. By the way, do you plan on buying a property or refinancing this year? The answer is yes. Then guess what? We're not going to be able to take all these deductions because we got to show some kind of income so you can qualify for a loan. Now, you can have it both ways. Great. We're going to take all those write-offs. We're going to show, gosh, you only made $24,000 this year. That's all you owe taxes on. Oh, and you want to buy that $1.5 million house. We've got that. So with that said, all you real estate agents out there, if you use a CPA, let them know you have access to this type of financing that is what? ATR compliant. This isn't the crazy loans that are stated income before the financial meltdown, which a lot of CPAs think any kind of a loan that isn't full doc, oh my gosh, you might go to jail if you do that. They're very conservative by nature, but literally explaining to them that these loans are completely compliant in that, guess what could be a better referral than my CPA, who knows where all my financial bodies are buried, telling me to reach out to this particular real estate agent because they can put me into a house because they know about this type of financing. There could be no better, I think, no better referral right there. Okay, moving along.
Divorce attorneys too, myself.
Oh, divorce attorneys, is that right?
Somebody's buying a house.
Yeah.
That's it. And especially a divorce attorney where the divorce is finalized. Now, he or she has to buy the other one out of the property. Well, if I take somebody off the loan, the other person doesn't really qualify, but I'm court ordered. Now, normally when they don't qualify, we love that scenario and we could potentially cash out the husband or the wife, depending on what the court order is. And Stacey, let me ask you, is that a rate and term, or we would consider that a cash out?
Cash out if we're buying out the other bar, the spouse, the ex. Is that
That's
your
right.
question?
Yep. Okay, you
But
guys.
it's like that because if you go to a divorce attorney, I mean, somebody's refinancing and the other person's buying. So there's a client for you right there.
Indeed, indeed. Okay, and again, never in the history of America has an accountant literally been able to offer their self-employed client both ways, all the write-offs and still qualify for you folks to sell them a house. So moving along here, what not to do. That's right, you guys. This pandemic, boy, I remember a year ago, I was convinced that half the people I knew were probably going to die from this pandemic, and it was crazy town back then. And a lot of people that had the means went online to make their mortgage payment, and there was a box to tick. Hey, do you want to go into forbearance and not make a payment? Not even talking to anybody. I clicked the box, and now I don't have to make my mortgage payment because of this unknown. Nobody really knew. We can still do loans for people that went in deferment even on their rent if they're a first-time home buyer. You guys, you want to touch upon, what we're doing as we're coming out of the back end of the Rona here?
Yep, I think it's important to note for all the realtors out there that we do have a full slate of options for anybody that either went through the hardship or maybe took advantage of the opportunity of taking a forbearance like Eric mentioned. So forbearance, any business owners that took PPP payments, any businesses that lost income, what we're finding on the bank statement side is although they may have had 1 or 2 months of a downturn, they usually picked it back up pretty quickly. Obviously, it's going to vary depending on what part of the country you're in, but the beauty of being able to use the average of the income and the deposits on those bank statements is we have some good months that make up for the bad months. So bottom line is we have numerous options for any of your buyers that were affected by COVID. Please make sure to reach out to your favorite loan officer and let them know that Angel Oak has some options.
Excellent. Next, you have clients out there when they're buying investment real estate, they have probably their favorite private money or hard money lender out there, and that's their lane. Ask them questions. How are you financing all of this investment property? Because I know of a program that we can cash out on, get you out of that 9% interest rate, not with a 3% origination, get you out of that 9% interest rate, cash out on that property, and let's go buy some more. Okay. All right, so the reason why B of A, Wells Fargo, all the money center banks cannot do this is because they're federally insured. And after the financial meltdown, when the Frank Dodd Act came out, they said any taxpayer backstopped entity cannot do what is known as non-qualified loans. So they're disallowed. So again, your agile broker that has access to these Angel Oak programs, they're the ones that can help you with these programs. Unfortunately, if you have your favorite loan officer at a money center bank, unfortunately, they're kind of shut out on these, aren't they, guys?
Yep.
All right. So right now, I would love to do some Q&A. And with that said, do we have the talented Steve Winokur on the line?
Eric, go ahead. Go ahead and ask some of the questions that we had sent over to you.
Okay, excellent. Hang on 1 second. All right, so on average, Stacey and Scott, what are you seeing increased as the buying power versus somebody that's self-employed going full doc versus now seeing what their buying power is with a bank statement. I know that we've spoken about this, but this point we want to drive home. You guys can sell them a much more, let's just say a higher value property, even into the luxury properties with a borrower that before really only qualified for maybe a $300,000 home. Stacey and Scott, what would you say the buying power is?
At least double. I mean, at least double.
At least
Definitely has the
double.
potential to go higher, depends on how much they write off, obviously, but you're qualifying for a 300,000 full doc bank statements. I mean, at least double. They're going to at least a $600,000 home.
Yeah, and that's huge because in the competitive market that we're in right now, you know, we're in South Florida, Stacey and I, and the market here is extremely competitive. There's multiple offers on a property, properties flying off the market, people paying over listing price. And so it's really important, and we know there's a big difference between having buying power for a $500,000 house versus having buying power for a $600,000 or $650,000. It's almost two different segments, two different markets. So it's huge to have that extra buying power from those bank statements, no doubt about it.
Thank you, Scott. Stacey, tell us about conforming loan limits, and do those apply with Angel Oak loans?
No, we prefer the jumbos. There's no differential between a $200,000 home and a $2 million home. We go up to 3 million loan amounts. Eric in California is going to push for even more than that. I don't have the luxury of having that high of a loan amount in my area. But, you know, we'll definitely push for anything, but the higher the loan limits, the better for us. We don't differentiate or get your rate or anything like that for the higher loans. We welcome them and we want them.
Yeah, that's it. We don't have any conforming loan limits. That's an agency thing. That is a government insured program. This is private capital. There's no conforming or jumbo loan limits. We don't deal with that. Okay. Any prepayment penalties on owner occupied and non-owner occupied loans? Scott, you want to take that?
We have no prepayment penalties on our primary residence and second homes. The only prepayment penalties we have is for our investment property programs, none on primary and second homes. Now, with the investment properties, if the borrower chooses to eliminate the prepay, they can do that. They can do a number of things. They can lower it down the amount of years, or they could just eliminate it completely. And there's numerous options on how they can do that. So the prepays really don't affect them much on an investment property.
Gotcha. Stacey, if I'm doing a bank statement loan, what if I don't have a business bank statement? What if I'm a sole proprietor and I've been at this, let's say maybe I'm in the landscaping business and I only have a personal checking account? Can I still qualify?
Absolutely. We'll take personal or business, doesn't matter. There's no difference in rate. There's no difference in loan to value. It's wherever you deposit your monies, that's the account that we'll take. Now, if it's a personal bank statement, anyone on that bank statement does have to be on the loan. But yeah, definitely personal or business does not matter.
I gotcha. And what if at the end of the month, my bank statement had literally only $10 as far as the balance? Let's say cash flow is kind of an issue with my business. I don't have a lot of money in the bank at the end of the month. Do I still qualify?
Yeah, we're just looking at deposits. We're not looking at outgoing. We're just looking at what's coming in, and that's what we're going to determine your income off of, is your incoming deposits.
Gotcha. And you're not looking at withdrawals?
Nope.
Gotcha. What if I'm bouncing checks? I've got a business account here, and sure enough, I'm kind of bouncing checks here and there, but I got a lot of money flowing in, and I'm an entrepreneur, and I'm all over the place. And the details of having enough money in my bank account, well, you know what? That's not a big deal to me. I've got a business I'm running here. Can I still get a loan on an Angel Oak bank statement program with bounce checks?
We are going to look at NSFs. Rule of thumb is 6 NSFs allowed in the last 12 months. So yes, you do want to make sure that you're covering your checks that are outgoing. That would be great, because we do require them to be less than 6 NSFs in the last 12 months.
Fair enough. Fair enough. Now, if I'm doing a personal bank statement loan and And I have, for some reason, I have my mother on my checking account because I'm kind of helping take care of her bills, and I'm helping out my elderly mother. And she's on my checking account, and I want to do a personal bank statement loan. Does my mother have to be a part of the loan?
Go ahead, Scott.
Yep. So in that event, yes, your mother would need to be on the loan. If you're sharing the bank account, both parties are on the bank statements. Both parties would need to be on the loan. Both parties would need to be occupying the property. However, that being said, Eric, I think we have some options there, right? So we also have our 1099 only program. Most of the borrowers that are looking to use the personal bank statement option is because they usually don't own a business, so they don't have business bank statements. So for those borrowers, 1099, usually we're able to use the 1099 only to qualify the borrower. So let's talk live example. I just closed one last month for a realtor. So to all my realtor friends on the call, that obviously 2020 in a lot of places was a banner year for real estate agents. 2019, this particular realtor wasn't the greatest year. What we were able to do is use just last year, just 2020 only's 1099, and qualify the buyer just off of the number on the 1099. We didn't have to average out the last 2 years. We didn't even look at 2019, strictly 2020. So there's options if you're 1099 self-employed. We can look at the personal bank statements, but if something pops up because we're helping mom out, we do have the option of the 1099.
Very nice. And I'm going to wrap it up with this last question, folks. Stacey and Scott, in your words, why don't more real estate agents know that these programs exist? What do you think the main reason is?
Stace?
Scott? No, I'm just kidding.
Let you go first.
Honestly, I just, it's getting word of mouth. It's getting it out there. A lot of them don't know. A lot of brokers don't know that these exist, which is why it's so important for us to do these webinars, to do all the marketing that we do. I think we do a phenomenal job of getting out there and getting it known what we do, how long we've been doing it. We are one of the leaders in this we are the leader in this non-QM arena. And it's just education, and drilling it home to brokers, getting them comfortable with our programs. And that's again why Eric mentioned before, if your mortgage broker, your favorite mortgage broker that you love to work with, isn't comfortable coming in and doing a presentation for realtors because they just aren't that knowledged or feel that they're that knowledged in our programs, we'll go out there with you. Because getting you educated, knowing that these programs exist, again, is going to expand your portfolio. It's going to expand your bottom line, which is your pocket, as well as getting everybody else knowing that these programs exist. It's just education.
That's it. Scott?
Yep, Stacey nailed it on the head. At the end of the day, it's all about the knowledge and awareness. And that's what we're trying to do, is bring the knowledge of these products and programs and the awareness that they exist and how they work to the realtor community. Quite frankly, to be a little more direct, Eric, I think we all know that in the last year or so, a lot of loan officers and mortgage brokers have really been very busy with refinance business. Refinances were just falling to their desk left and right. And in a lot of cases, they neglected buyers, realtors, etc. And it's easy for them to sit there and just knock out these conventional real estate cash out refi, rate and term refi loans. So they haven't really gotten out there and expanded and just talk to the realtor community about these programs or use them. That's really what it comes down to. But the bottom line is, realtors, you guys make money when you sell homes. We make money when we close loans. And we've always been primarily a purchase-based company. And that'll continue, in my opinion, through the next couple of years. So align yourself with loan officers, mortgage brokers that are approved with Angel Oak, that have knowledge about these products and programs, because they're only going to help you add more tools to your tool belt to be able to qualify more buyers. If you don't have a loan officer or mortgage broker in your area that you're hooked up with, that is approved with Angel Oak, just reach out to us and we'll connect you with one that is.
Thank you, Scott. So to wrap up, folks, what they just said is right. Think about it. Angel Oak is not going to advertise on radio or on TV that, hey, these programs exist. We're 100% wholesale. So we only do these loans through our broker network. So, and I believe that all of us on this call, we all fear the unknown. And if I'm a loan officer, the last thing I want to do is start talking to somebody about a bank statement loan when I really don't understand it. And how am I going to answer these questions? That's painful. And as Scott pointed out, they are so busy doing rate and term refis, just kind of knocking those out, that they really don't need to be hungry for these programs. So thus, another element of why this market is still so underserved. So with that said, thank you folks very much for taking the time out of your busy day to learn about what we're doing here at Angel Oak. Remember, we love scenarios. With that said, you guys, thank you, Scott. Thank you, Stacey, very much.
Thank you.
You guys go back to funding all those, go back to breaking stuff like sales records. These
Have a
two.
wonderful month.